Biotech seed funding has reset, but that's not a bad thing after years of hype. The biotech seed market has entered a new, more disciplined phase. In Q1 2025, only 35 seed rounds were close levels we haven't seen since 2014-2017. What's driving this, and how can we catalyze innovation in this new climate? Here's a quick breakdown of the top 5 factors behind this shift. 1. Post-pandemic investment normalization. After 2 years of unprecedented investment, investors are reverting to pre-2020 patterns. In the first quarter of 2025, seed deals accounted for only 5% of total VC funding in the sector, and seed round volume is back to 2014 levels. However, there's a silver lining to this cloud. This means that companies don't need to raise huge amounts of money just to survive. Instead, they can focus on generating revenue and proving their concept before seeking further investment. 2. Capital concentration in late-stage deals. Large late-stage deals soak up investor bandwidth. For example, Isomorphic Labs recently raised $600 million. Imagine trying to find the next isomorphic among seed-stage companies. It's a daunting task. These behemoth deals dwarf seed investments and divert investor focus away from early-stage companies. Consequently, the average seed round size has shrunk by 20% since its peak in 2021. In the current climate, founders must be prepared to raise smaller rounds with smaller valuations. 3. Long ROI timelines plus high risk. The long timelines and inherent risk of biotech make it less attractive to invest in seed stages, especially in a high interest rate environment. The path to commercialization for many biotech firms is 10 years with 80% plus failure rates. This is not an ideal investment profile when there are numerous other opportunities in the market with potentially shorter timelines and lower risk. However, this does not mean that all seed investments are dead. It simply means that the bar for investment has risen significantly. Now more than ever, companies must have exceptional science, a compelling value proposition, and a strong team to secure funding. Additionally, they need to demonstrate a clear path to profitability. This may involve pivoting to a more capital-efficient model or pursuing partnerships to validate and de-risk the technology. 4. Regulatory and policy headwinds. The FDA is scrutinizing therapies more closely, while IRA drug pricing measures add uncertainty for investors. These regulatory changes impact the predictability of clinical trials and commercialization, making it challenging for investors to forecast returns. Moreover, the pricing negotiations under the Inflation Reduction Act are far from settled. The outcomes could result in decreased revenues for pharmaceutical companies, affecting the overall financial outlook for biotechnologies. This increased regulatory burden and policy uncertainty make the investment landscape more treacherous, particularly for early-stage companies with limited resources. As a result, investors are naturally more cautious when considering seed investments. 5. Ecosystem saturation. There are simply too many companies doing similar things. The explosion of new companies post-2021, particularly in gene therapy and cell therapy, has led to a market saturated with numerous startups offering similar solutions to well-established problems. With so many options available, investors are becoming more discerning, focusing on backing companies that have a clear differentiation and a robust path to commercialization. This trend highlights the importance of conducting thorough research and due diligence before seeking funding. Companies that take the time to refine their offerings and demonstrate a strong value proposition are more likely to stand out in this competitive landscape and secure the necessary investment to succeed. In conclusion, the biotech seed market has indeed entered a period of adjustment. However, this shift should not be viewed as a setback, but rather as an opportunity for more thoughtful and strategic investment. By implementing the strategies outlined in this video, biotech companies can position themselves for success in this evolving landscape. Furthermore, as the market matures, there will likely be more opportunities for collaborations and partnerships, which can help accelerate the development and commercialization of innovative therapies. Embracing these changes and adapting to the new market dynamics will be crucial for the continued growth and success of the biotechnology sector. Thank you for watching. If you liked the video, please subscribe for more content like this. You can also support us through various platforms whose logos you can see here. If you want to learn more about the future of biotech, check out our previous videos. We wish you all the best in your scientific endeavors and hope that you continue to learn and grow with us. Until next time, stay curious and keep asking questions. The world of biotech is constantly evolving, and we're here to help you navigate it. Thank you once again for being part of our community, and we look forward to seeing you at our next video.